All right, 624 gang. I have a series of videos that I'm going to get done here. This is the first one where we're going to work through the highlights of Chapter 1 and Chapter 26. It's a bit of a smattering, if you will. So Chapter 1 is kind of intro and a whole bunch of different taxes, and then they leap off and get into some tax practice issues. And then Chapter 26 is about how the IRS operates, and that's relevant, but less relevant to me for this class. What is more relevant is we'll focus on the penalties, the statute of limitations, and how being a tax preparer is regulated. So, because I think that is fairly important, especially, of course, if you're going to be a tax person. Okay, let's get started. All right, chapter 1. So I know you guys are super interested in reading about the history of U.S. taxation. So I thought I would read that entire section of the text to you word for word. Are you ready? Yeah, I'm not going to do that. So let's start with, here we go. Our agenda, again, as I said previously, like 3 seconds ago, chapter 1, chapter 26. We can't do a Q&A though. We'll have to do that in class. So what is a tax? So we've got to start at the baseline, right? For, every once in a while I get an international student in here and they've never experienced personally taxes for themselves. Of course, I doubt there's a country on earth though that doesn't have them. So a tax is a compulsory payment to support the cost of government. And the key components are that payment is required. It's imposed by a government agency, so federal, state, local, doesn't matter, and the payment's not directly tied to a benefit that's received by the taxpayer. Now, that's a direct tie because, in theory, a lot of taxes provide an indirect benefit to every citizen of the country in which they're being taxed. You can contrast that with a fine or a penalty or maybe even a user fee. So the federal income tax is used for lots and lots of government programs, whereas when you purchase a fishing license, right? So you need a license to fish in the state of California. That gives you a specific use, right? There's a specific benefit. That benefit is the ability to fish legally. Same with like a vehicle license or your driver's license. Parking tickets, those are fees, right? Those are not the same as a tax. They are charged by our government, but they're not the same as a tax. All right, so the basic tax formula, and nothing gets more basic than this. Tax equals base times rate. Base, we usually think about, let's take the income tax. What's your base? Well, it's your income. Rates can vary. They're usually expressed as a percentage, but not always, right? Sometimes they're just a flat dollar amount, for example. But in any event, to get to a tax, you multiply the base times the rate. So there's lots and lots of taxes covered in the book. It gives a nice overview of a number of different ones. I've listed some of them here. I'm going to give you a little extra detail on some of these. So there are now local income taxes. These are starting to become more and more popular. I believe now Seattle has one of these. So Birmingham, Alabama, Denver, Colorado, New York City. These are cities that actually have a municipal income tax. So we can probably expect more of these as municipalities, bear a greater share of costs. It wouldn't surprise me to see more and more of these. Property taxes. Again, the book does a reasonable job of describing what these are. In almost all places, property taxes are called ad valorem taxes, and ad valorem just means based on value. Typically, it's the value of the property, but California, through something called Prop 13, has an entirely different system. So I just want to make sure that, you go through a tax class, you ought to understand how California's property tax system works. Most, like California's, focuses on a real property. Real property is real estate and buildings and things attached to real property. you can compare that to personal property. Personal property doesn't mean personal use property. So, for example, I own a home. My home is real property, but it's personal use property. The furniture inside my home, that's personal property, and it's also personal use property. Whereas the furniture in my office is personal property, but it's business property. It's not personal use property. Anyway, a quick overview of property. That's actually a later chapter. But when there's a personal property tax, it tends to focus on intangibles. Okay, so let's talk about California. Again, real estate taxes are common, personal property, less common. Prop 13. So Prop 13, it's at least 20 years old. It's got to be more than that. It's probably 30 years old now. So what in most states, what happens is your property gets revalued about every 3 years. So there's actually an assessor's office. They've got a bunch of economists that work there, and they go out and they look at buy and sell data and try to establish what the value of your home is. And that's its assessed value. Then they apply the tax rate against that assessed value, and that's the property tax you pay. And so in theory, what happens is, at least every so often, your tax base is updated to reflect the actual value of the property. Under Prop 13, it can be reassessed, but the limit, number one, is 1% of its assessed value. And its assessed value can only be increased by a maximum of 2% per year unless it sells. So what happens is, if you bought your home 20 years ago, you're sitting on an assessed value that is likely to be very low relative to its actual value. And what that does is it creates distortions in the marketplace. Now, we could argue about whether that's a good thing or a bad thing. And if we were face to face, we'd have that exact argument. But if you want to raise that in class, I'm happy to talk about it. But it is true that what happens is you end up with low assessed values on homes that have been lived in for a long time. Anyway, there's a cool article that I posted in Canvas for you to read if you're really interested. But just so you know, since the Case-Shiller Index has existed, and this is Case-Shiller on San Diego itself, the San Diego metropolitan area, since 1987, the average increase in home values has been 5.72%. And if we're only compounding at a maximum of 2%, under Prop 13, you can see that it's not going to be very long before actual values far outstrip assessed values, and that is in fact the case. Here's what a property tax, a California, at least a San Diego County, California property tax bill looks like. You can see that they provide assessments of the property. Again, that's your base for property tax. It probably understates the actual value of the home, but it depends on when you purchased it, right? So if I just purchased it, that is in fact its assessed value. And what happens is the estimates are made after that. In California, we have lots and lots of other property taxes that sometimes get tacked on. So if you look up here at the top, we've got the 1% on net value. That's really the state property tax. And then these other items on the left-hand side, these are items that the voters in that community approved. And so you'll see things like Palomar Community College, Poway Unified Bonds. So this is obviously someone who lives in Poway. And by the way, you can look up anyone's property tax bill if you just go to the San Diego County Assessor's website and you put in an address, any address, the property taxes are available to you. That's public information. In any event, you see on the left, these are things that got voted for. So the citizenry said, yeah, I'm willing to pay $328.99 for Proposition C for a bond for Poway Unified School District. On the right, again, below kind of that total on net value, are some fixed charge assessments. So these are things that they're not based on value, but you do pay for. So vector disease, mosquito surveillance, that's, insect control, landscaping, water authority, things like that. These are all amounts that you're paying to cover things that the city's providing for you or the county might be providing for you. In any event, when you total those up, you can see they're not insignificant, right? Voter approved charges are $1,400 a year, and other assessments are about $350 a year. So not insignificant. Okay, so states, a lot of this class we spend the bulk of our time on income taxes, and we'll see why here in a second. But along with a federal income tax, many states have an income tax. Now, not all of them do. There's a list here. Tennessee actually eliminated theirs, I believe, starting last year, so they no longer have even a limited income tax base. New Hampshire has retained theirs, but you can see there are a handful of states that don't have any income tax at all at the state level. Most state income taxes are based on the federal adjustment or the federal number. So it's kind of like start with your federal AGI, which we'll get to, or your federal income, and then make state adjustments to it. That's how most work. California is probably one of the most complex. That's no surprise. We're a really big state with a lot of people. And as a result, we have a fairly complex tax system at the state level. There's also corporate state income taxes. Again, there's a different set of states that have no corporate income tax. You can see some commonalities between the two states. That means those states are probably deriving their state revenues from other sources besides income taxes. So let's take Nevada as an example of that. We can probably guess where Nevada generates a lot of its tax revenue, and that's from the gaming industry, right? No surprise. Some other states like Wyoming, for example, gets a lot of theirs through what's called a severance tax, which is the extraction of natural resources. There's a lot of coal and timber and that sort of thing in Wyoming. So how high are individual income tax rates in your state? Tax Foundation is a really good nonpartisan tax think tank that produces a lot of great information. This map is directly from them. This is for 2021. The darker the red, the worse, meaning the higher. Well, I shouldn't say worse. That's pretty pejorative, right? But the higher the tax, I guess if you're paying them, a lot of times higher is worse. If you're not paying them, then lowers, then who cares? Higher is probably better because someone else is paying. In any event, California, as you can see, congratulations, we're the very highest. We have the highest marginal rate in the country. Good for us. So at 13.3%. Here's what our tax table looks like. So it's a progressive rate structure where you're the higher your income, the higher the rate is, and you can see that the table caps out at 12.3, but that's because there's an additional 1% tax on incomes over $1 million. I love the fact that that's not included in the table. Like we're keeping a secret from anyone. Give me a break. Because really it should say 625, 369 to $1 million, 12.3. Above $1 million, $1 million and over. I take it back. It is above $1 million, 13.3%. In any event, fairly progressive rate structure. And again, we are a high taxing state, no question. So sales taxes, another big source of revenue for the states. You can see, again, we have states that have no sales tax. Alaska appears in a lot of the low tax or no tax states. Same with New Hampshire. The motto on the New Hampshire license plate is "Live free or die." So they're pretty proud of their libertarian approach to things.
U.S. government. Hi, is this the tax department?
Yeah.
Okay, good. Everybody keeps telling me about taxes. I keep hearing about taxes. What are taxes? So every year you owe us money, and that money that you owe us is called taxes. Okay, well, how much do I owe? Well, you have to figure that out yourself. So I can just pay anything? No. We know exactly how much you have to pay, but you still have to figure it out for yourself. Okay, well, what if I get it wrong? If you get it wrong, you go to prison.
Sales taxes can vary from state to state, just like income taxes, and they do, and not just the rate. the base can also vary. So it's not uncommon to see exemptions for food or medicine or clothing, even in some states, or other forms of necessities, right? So things that are identified as necessities often are not subject to sales tax because otherwise that would become regressive with respect to incomes. So state base rate in California is 6%. Every county charges a 1.2%. 1.25% kicker on top of that. So think of it as no matter where you are in California, the minimum you're going to pay is 7.25. And then in California, cities are allowed to add their own level. So, for example, within San Diego County, you got San Diego, El Cajon, National City, and Del Mar, all with rates that vary from 7.25. And these rates update and change pretty frequently. So this is something where you would probably want to go to the website that I've listed here on the bottom of the slide if you ever needed to confirm a particular sales tax rate. Gasoline taxes are a form of an excise tax. So when we think of excise taxes, the big three are alcohol, tobacco, and gasoline. And a lot of times excise taxes aren't on the dollar value of something, but rather its volume. So cigarettes, think of it by per pack or per carton. Liquor is by the liter or the gallon, and gasoline is definitely by the gallon. However, the federal rate on gasoline is 18.4 cents per gallon. It's been that for a long time now. It really has. There's no reason to increase it necessarily because, of course, the price of gasoline is going up without any taxes on top of it. State rates vary widely. Anyone who's driven to Utah or Nevada will see a pretty dramatic difference at the pump for gasoline just between going through those states. And in a classic California exceptionalism, we have the highest gasoline taxes in the country. Good for us. So for a while there, Pennsylvania was beating us out, but we've swept in and taken first place back. So big disincentive, right, to buy gasoline in California. Many layers to our tax here. So first, there is an excise tax, as I mentioned, of 50.5 cents a gallon. Then there is a sales tax on top of that. That's a state level sales tax of 2.25%. That's based on the money you spend at the pump, not the gallons. Then there's a county level sales tax, and that's based on a weighted average of the gas pumped around the county. So what they do is they establish what the different tax rate is in all the different places and say, okay, well, we'll take a weighted average based on the amount of gas pumped in each of those locations and add that as the county level sales tax. And then there's an additional 2 cents per gallon underground storage tank fee that helps for when gasoline generally before it comes out of the pump is in a big tank underground, and those have had a tendency to leak from time to time, and that collection is intended to cover the cost of remediating that sort of problem. Again, I spoke about severance taxes a little bit ago when I talked about Wyoming. Those are charged on the removal or sale of natural resources. And there's a bevy of other taxes out there. I'm sure you've heard of like the soda tax. New York City had a tax on soda for a little while. Somewhere on the West Coast does, either Seattle, Portland, or San Francisco. There's a tax on fishing equipment that's separate from the sales tax. So there's almost nothing that's not taxed in some way, shape, or form.